Okay, guys, let's have a little look ahead then at this ECB meeting, rate decision, press conference. And things are balanced. I'm just looking actually, look at the DAX chart here. I've got all these charts set to daily time frames. Look at what's happened here on the DAX. 1st of March, pop higher, up through the trend line. Look what's happened ever since then. Look at this. We've got 7 days, 7 daily candles in a row of pretty much dojis, as this thing just now doesn't know where to go. Where do we go next? Is this big bounce off the 11th of Feb low? Has it finished? Have we hit the 27th of January high and momentum's gone and we're now looking back down towards 9,000 and even retesting the low of the year? Or is this just a kind of halfway house on what becomes a bigger rally? And there's only one man who has the answer to this, and his name is Super Mario, and he's about to tell us which way this market's going to go. So you better pay attention. This is the governing council. These are the people with the power. Of course, Mario, top dog. Now, what's interesting about this, these are all the guys on the council, right? You get Draghi at the top, you get his 5 executive board members who are always there. Then you get representatives, the 19 governors of the 19 countries. Now, what's quite interesting, a few conspiracy theories flying about, what's quite interesting about the way they do this is not all 19 governors vote each meeting, and they rotate it. If I just scroll down and show you the table, in fact, so you can see where there's a tick, that means the person is voting today. Where there is no tick, or where there's a cross, well, that's the people who have rotated off and are not voting today. So you actually only get, let me just count, you get 4 of the 5 governing council vote at each meeting, and then you get 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 of the rest. Now, what's key about this and what's really interesting and what's flying about, some rumoring, is this cross right here. Coincidentally, I mean, is it fate? Is it coincidence? There's a little cross next to a guy's name called Weidmann. Look at him. In the opinion, he is the Uber hawk. In fact, Uber doesn't even cover it. I don't know what, there's a stronger word than Uber. Super Uber hawk. He's got a cross next to his name. He's not voting today. Is that going to be key? Are we, and this is very political, of course, are we going to see Draghi sneak through an aggressive stimulus package because Weidmann's not voting? If he does that, then of course it could, well, maybe irreparably damage political relationships within this council. Or is Weidmann still going to have his usual influence over the group just from the back seat, though? So it's just quite interesting to note Weidmann is not voting today. The Uber hawk, it has no weapon. So we'll see. That's just a side note. Now, let me just show you the data calendar. Timings, 12:45. We're going to get an announcement on rates. Are they going to cut the refi rate? The answer is no. Or, well, very unlikely. We're expecting it to stay at 0.05%. Are they going to cut the deposit rate? Almost certainly. And consensus is for a 10 basis point cut to minus 0.4% from the current minus 0.3%. Are we going to get a movement on the marginal lending rate? No. Again, not expected. That's expected to stay unchanged. All we're going to get at 12:45, all we want to know, are they cutting the deposit rate? And if so, by how much? Now, what's really hard to know, because it's not just are they going to cut the deposit rate, are they going to move to a tiered deposit rate system? If so, are they going to announce this at 12:45? Or is that more complicated a policy to communicate and we'll wait for Draghi to mention this in the press conference? I mean, I think if they're going to move to a tiered deposit rate system, they're going to have to somehow mention this at 12:45. Maybe they'll say we're going to cut, I don't know, to whatever, minus 0.4, minus 0.5, but we're moving to a tiered system, more details in the press conference. They've also been using this 12:45 announcement to give us guidance there's more to come. So there's more policy to follow in the press conference. This will get announced. If they're going to change the QE program, which, well, they kind of have to, given expectations, then they're going to announce that there's more to come in the press conference, all right? But here at 12:45, it's mainly about the deposit rate. How low are they going to cut it? Are they going to mention a tiered system here or not? Then we move to the press conference, okay? It's pretty complicated here in terms of what they could do. So let's talk about the various different things. Let me just go to a different screenshot here. I'm going to bring this in here. This is a little small, but let me just zoom in on the left-hand side a little bit here. There's so much they can do. I mean, varying degrees of effect. So here's all the different options they've got in the toolbox. Guidance. So this is introducing inflation target range. So rather than a 2% inflation target, move to a range of between 1 and 3. I doubt this is going to happen. Introduce a core inflation target. I doubt this is going to happen. Lift inflation interpretation target. Strengthen forward guidance, certainly. Okay, so I'd expect that. Of course, the deposit rate cut. So they could cut the deposit rate by 10 basis points or even 20 basis points. They could do one 10 basis point cut today and indicate there's more cuts potentially. They could cut more aggressively in one hit. Then there's QE. Just in the QE space, there's many different options here. They could expand the monthly amount. Remember, it's 60 billion a month. Are they going to increase it to 70? What about 80 billion? They could extend the program. So currently it's due to end March 2017. Are they going to move that to June 2017, September 2017, or beyond? They could buy different stuff. So they could change the range of products that's available for purchase in this program and move to, so therefore widen the pool of assets available. Now you've got to say, if they're going to expand the monthly QE purchases to 70 or 80, or indeed extend the program, they've got to look at expanding the available assets for purchase, because there's not going to be enough just looking at government bonds, especially if they're going to keep their rule of not buying any bonds that have a yield lower than the deposit rate. So they could buy other stuff. They could buy corporate bonds. We may well see that happen today, an announcement they're going to move into more corporate and financial bonds as part of their QE universe. They could even, theoretically buy equities. It is more aggressive, of course. They could buy non-performing loans. There's other stuff they can move to here. I actually quite like the idea of, in order to expand the pool of available assets, I like the idea of just scrapping the deposit rate floor. So currently the deposit rate's minus 0.3%. They can't buy any bonds that yield lower than that. That means all German bonds that have a 6-year duration or less are unavailable for purchase. They are running out of German bonds to buy. This is a problem, especially if they want to increase their QE program. So they've got to do something. They can't expand or extend without also looking at increasing the pool of assets. So it's how are they going to do that? How risky do they want to get? Corporate bonds, scrapping the deposit rate floor is likely or possible. Then more aggressive, unlikely, would be buying equities or non-performing loans. Liquidity operations, so telcos, targeted long-term refinancing operations. These are possible. I quite like this as an idea. The problem with using the same old tools, if all they do today is cut the deposit rate by 10 basis points and extend the QE program by another 6 months, i.e. do exactly the same as they did in December. If that's all they do, I'm telling you, markets are going to be disappointed. This is going to be a disappointment. What you really need to look at today is actually the reaction in European financials. Because if all they do is do a straightforward deposit rate cut, well, I tell you what, the negative side effects are going to start to outweigh the possible benefits of that policy. We are heading for a major sort of car crash if all they're going to do is just carry on cutting deposit rates, carry on extending QE. It hasn't worked. Hasn't worked. Proof, this chart here. Here you've got the five-year inflation swap chart. This is like long-term inflation expectations. Look where we are. Okay, we've banked slightly here, but look where we are compared to the same time last year when they announced QE. We're lower. We've had a whole year of QE. We've had many months of negative deposit rate. It's not worked. So why would they carry on increasing policies that don't work, especially with the threat to the banking system? The more they go negative on rates, the more it squeezes banks' margins. And, you know, the more likely we're going to have a policy error situation where the banking system collapses. They've been squeezed too much. The banking system collapses. Monetary policy fails. We have another credit crunch. You know, this is the risk of carry on using these blunt tools that don't work. So if that's all they do today, if all they do is cut the deposit rate and extend the QE program by 6 months, we are having risk off. I can guarantee it. They need to do something clever. It needs to be something outside the box. What I want to see is a cut to the deposit rate, but a move to a tiered deposit rate system. So this means they can cut the deposit rate, but it actually has less of a negative effect on banks' margins. So they can say that, like Japan did. Japan cut their deposit rate into negative territory a few weeks back, but actually all they had was a tiered system that meant that current deposits don't get charged at a higher negative rate. It's only new deposits going forward from this point. So they could say, we're cutting the deposit rate to minus 0.5%, but only for new deposits, not for existing deposits. That's one way they could have a tiered system to encourage banks to, all right, fine, you've got deposits with us at the moment. Yes, we're charging you for that. That's hurting your margins. What we want you to do is lend more money. So we're going to penalize you more on future increases in deposits because they've got money flowing in the banks because ultimately the ECB are buying bonds off them. So they've got cash coming in and they're just parking it back at the central bank, and the ECB want that to stop. They want this liquidity to get out, credit lines out into the system and get the economy growing. So maybe a deposit rate cut with a tiered system. I actually like the TLTRO idea. You know, if they really want to drive an increase in lending, which is difficult if there's not an appetite for borrowing, by the way, but if they do want to increase credit lines, then the best way would be a TLTRO with a negative rate. This is a targeted long-term refinancing operation. This is a collateralized loan. This is where banks take money, pass collateral back to the ECB, and then they have a loan for whatever, 3 years. But the deal is they've got to lend it. Now, you could have a negative rate on the TLTRO. That means that the ECB pay the banks to take this money and lend it. I think that would be a pretty powerful and direct policy. I just don't think we're probably, I'd like that announced today, but I don't think we're quite ready for that in the ECB's mind. I think things need to get worse before perhaps we turn to that kind of policy. Right, let's just look at what the banks think. Investment banks, what are they considering on the deposit rate? Here you've got Goldman Sachs thinking 10 basis point cut, and you know, they think they'll get resistance from several members who have concerns about possible negative impact, but they think a 10 cut. JP Morgan are going for a 20 basis point cut. And they think in June they'll go even more to minus 0.7%. BNP Paribas, I think 20%. ECB think 10. Citigroup think 10. Bank of America 10. Everybody thinks a deposit rate cut. I just hope they're going to have a tiered system. Let's move down. What do the banks think about QE? Goldman's think 10 billion increase in the speed of purchases to 70 billion a month. JP Morgan think the same. They want 70 billion a month. They also want to extend the program to June 2017. They also think 2 additional TLTROs in the second half of 2016. So BNP Paribas, I think 10 billion increase. I mean, I'm just reading Nomura are the most dovish. If Nomura are right, then this day today is going to be spectacular. And it will really be a pivotal day for the year, because if Nomura are right, this is going to be an interesting session. Nomura think basically everything is going to be delivered. So they think, this is what Nomura think are going to happen. They think that the ECB will cut the deposit rate by at least 10 basis points. They think they'll increase the speed of purchases to 70 billion a month instead of 60. They think they're going to extend the QE program by 3 months to June 2017. They think they're going to remove the deposit rate threshold for the QE purchases. They think they're going to announce 2 targeted long-term refinancing operations. They also think they're going to have dovish communication, so forward guidance on rates. A willingness to move rates even more negative, but also having some kind of policy to cushion the negative impact on banks. They think the full Monty, and who knows, they could be right. The other thing to look out for today is not only, obviously, decisions on policy, which is the most important, they're also going to be revising their inflation and GDP targets. Now, this is the thing, I showed you that inflation chart here, because ultimately the inflation picture in the long term looks very negative. One second. The inflation in the long term looks very negative. I'm just showing you, this is the expectation from Nomura here. You can read that as I'm just talking. So the inflation situation looks very negative. What we're expecting is the ECB to revise down, and this is key. We think they're going to revise down their 2016 inflation forecast. It used to be 1% inflation for 2016. It's expected they revise that down to just 0.1%. If they make a revision to their inflation forecast of that magnitude, they absolutely have to deliver something pretty substantial today. Ultimately, they've got a single mandate. It's inflation. They've spectacularly failed. Their policy efforts of the last 12 months failed. So they've got to do something else. So as we get closer to this meeting, even though we've had a bit of a risk bounce over the last few weeks, the inflation outlook is the most important thing. And ultimately, it's dropped dramatically, and we're going to need to see more. And it's the inflation outlook that might allow Draghi to deliver a big package when Weidmann's not voting. They're also going to revise down their GDP projection. It's expected to revise down from 1.7% to 1.4% for 2016. Okay. Let's think about market reaction. And how far can markets move? Look at this table. This is how far markets moved off the back of the last few meetings, okay? So in December 2015, the euro-dollar went up by 2.99%, 500 pips, one of the most dramatic days in the history of this currency pair. Huge move. The Bund dropped, yields rose by 19.7 basis points, massive move. Look at the Euro stocks, dropped by 3.14%. December last year was phenomenal because Draghi promised us a huge package and he delivered us a little whimper. It was a spectacular under-delivery by Draghi in December, and markets went through huge scale movement. There's potential for this, but in the opposite way, I mean, we're expecting, look at the euro-dollar, for example. We are expecting, pretty decent policy today, and yet the euro-dollar is trading at the 110 handle. When we went into the meeting in December, we were trading at the 106 handle. If Draghi delivers today, we could get big moves lower. 300-400 pips. I mean, if Nomura are right, could even see the low of the year or even the low of December tested. That's 500 pips. We got that move in December. Why not the reverse of it today? But only if Draghi delivers on absolutely all fronts. Okay, he could spectacularly underdeliver like he did last time in December. We could go north. Up above 111 would be key. 112 perhaps. I think there's more room for downside than upside, but you could get big moves here. The DAX finally poised. Do we go and break this double top, the end of January and the March highs, and push on up to 10,100, 10,200 easily? We could get up there if Draghi properly delivers. Or is Draghi going to call an end to the month-long rally? If so, if he properly underdelivers, 3-4% sell-off for the DAX, no problem whatsoever. You could even get down to, maybe 9,000 is too far. But 9,200 if we get a big move. You can definitely get big moves here. Make no mistake about it. The Bund, big rally, of course, over the last few months. And, obviously, if Draghi properly delivers, I don't know, for the Bund it might be a little more difficult, I have to say today, because if he does something like increase the speed of purchases, and you could think, right, well, that means he's going to buy more Bunds, so Bund moves higher. But be careful if he scraps the deposit rate floor, because that actually means, probably not going to buy more Bunds, but actually buying more short duration German bonds, which are currently unavailable. So it's feasible to get the scenario where they increase QE and Bunds sell off. Be very careful with the Bund. If they scrap the deposit rate floor, that should be out and out negative for the Bund. All right. I think the Bund might be tricky today. The only way it's going to be easy is if they expand the QE program without increasing the pool of available assets. Well, then sure, the Bund's going north because the Bund's pretty much the only German asset they can buy. Okay. But if they alter the pool of assets, don't think it's going to be straightforward for the Bund. Okay. And that's it. What else to say? I mean, be very careful. The rate decision at 12:45, we're in unknown territory here. Are they going to announce? They're going to announce a cut, but are they going to announce a tiered system at 12:45 or not? They're going to say there's more to come in the press conference. Don't forget, Ant's just reminding me of the December fiasco of the FT tweet. We got the FT tweeting no rate cut before the announcement. Markets kind of reacted sharply. Then the FT pulled the tweet, and actually then they did cut rates. So don't forget, we could get anomaly scenarios like that. So just be really careful. But you could get epic movement today. It really could be the afternoon of, the year. But only if something dramatic happens. And the dramatic scenario is if he spectacularly underdelivers like in December, or if he delivers the full Monty. And I think there's more chance of the latter, simply because of the inflation situation has taken a massive turn for the worse. And that's what's different about this meeting than the meeting in December. I'd love it if he delivers an Nomura-style full package, and then we're going to get movement. All right, so always be careful on risk. You're going to get a lot of volatility. So 12:45, rate announcement, and then the press conference beginning at 1:30. Good luck.